Hi traders and welcome back. My name is Marco Meyer and today I'm going to talk about small stops means less risk means better risk reward ? This is a topic that came up as a follow-up from last week where I did a little video about stop losses in general and then got some emails about this because I mentioned that for ambush, for example, I use a stop loss of 1.5 times the daily average to range, and the question was, hey, isn't that quite bad for your risk reward ratio? Wouldn't it make sense to use a smaller stop loss? And I see that a lot these days, and it was one of the things where I had the same idea of the whole risk reward thing a couple of years ago, and I remember quite well that when I met Joe, he talked about the thing and mentioned that risk reward doesn't make much sense and that it's the wrong way to look at it. And I was almost a little bit angry back then because I just didn't understand what he meant, because I was so sure of the concept. You could find it in a lot of trading books, and yeah. So that's today's topic. And I'm going to start with a little example just to make clear what this is about. So here, for example, we would have two trades and they're totally made up, just to have an example. The first one would be buy the E-mini at 1980. Second trade, same thing. Profit target for both trades at 1990. So that would be 10 points. But now on trade 1 we have the stop at 1970, and on trade 2 we have it at 1975, and that's a difference of 5 points, which ends up the first one giving us 10 points risk, 10 points reward. So either we make $500 or lose $500, giving us a risk reward of 1 to 1. Now the second trade, where we have a tighter stop loss of just 5 points, we have a risk of only $250, still with a profit target of $500. This gives us a risk reward of 1 to 2. Now looking at just this example, and if we leave position sizing out of the game and only look at this single trade without even considering its outcome, then on a theoretical level the above statement is true, meaning yes, smaller stop loss, less risk, better risk reward. But there's a problem with that, unfortunately. And that is that risk reward is a really nice idea, but the markets actually just don't care about your risk reward requests. At least I couldn't find a field on my trading platform yet where I place an order and then I say, and by the way, this is my wish, please go there. And instead you just get from the market what you get or don't get. Trading, as you know, is a numbers game, meaning it doesn't make sense to look at a single trade, and it doesn't make sense to look at a theoretical idea of a trade where you set your risk reward like you want to have it. Instead, you have to look at a lot of trades and then look at the results of these. And that's why the whole risk reward thing for a single trade doesn't mean too much. It's just something that looks really good on a spreadsheet. Now, why is that so? Because in theory it should work, right? But while tight stops might actually decrease your theoretical risk, or if you then do the whole thing and increase your position size while decreasing your stop, and then you increase your risk reward by doing that, in reality, when you trade in the real markets, quite often the opposite happens. You increase your real risk and you decrease your real reward. So the opposite happens of what you want to do. And let me explain that a little bit. Because if we look at this part of trading where we say, okay, the whole risk reward thing, there's a lot of more things that matter and are important. But now just looking at that aspect, if you really want to get an idea of it, then we have to look at a combination of the average winning trade, the average losing trade, and the winning percentage over a series of trades, not a single one. We're going to make 3 trades here. And the first case is going to be where we want the risk reward of 1 to 2, so you want to make 2 times as much as your risk. Second one, we're happy with the 1 to 1 risk reward, so if you make 500, we can also lose 500, and that's fine. And in the last case, we're going to lose a risk reward of 2 to 1, meaning we're going to risk double of what we can make. So we either lose $500 or we make 250. Now, if you look at this series, in the first case, what you can see is that trade number 1, we would have been stopped out, lost $250, 1 times the risk. Trade number 2, same thing, and trade number 3 would have a winner of $500. So here we would have made our profit target. Now the end result would be 0. Now, of course, just on that theoretical level, leaving out commission, slippage, and so on. But that's fine enough to make the point here. Now, in example number 2, first trade would be a loser. We lose $500, but the second trade compared to trade number 1, we would actually have a winner here. So while trade number 1 we got stopped out with a $250 loss, on the second trade we actually made $500 because the $500 stop didn't get reached. Trade 3 we also made $500 like in trade 1, of course. Now the result here would be better than the first case. Last example would even be more better because the first trade we would have reached our profit target of $250 while not reaching the profit target of $500 and then get stopped out. But working with a small profit target, we would have hit it and actually made money in all 3 trades, making this the overall winner. Now, does that mean I'm telling you you should trade with a lower risk reward or that it's bad to trade with a higher risk reward? Of course not. What I'm telling you is you have to look at a series of trades of the strategy you're trading or your past trades if you don't trade in a systematic way, and then look at these numbers and then see if that risk reward you want to use makes sense in the market you're trading or not. Because on the theoretical level, it's totally useless. What's counting is at the end, after a year of trading, for example, after doing hundreds of trades, what's your average winning trade, what's your average losing trade, and what percentage do you have? Because you can have a risk reward of 1 to 10 and make a lot of money with some strategy, and you can have strategies where you have a risk reward of 5 to 1 and make quite a good amount of money. It really depends on the strategy and the market you're trading. So let's have a look at the ambush trading method, trading natural gas from 2011 till yesterday. First of all, let's use a stop loss of 1.5 times the initial risk, which in this case is the daily average true range. And that's the statistic we're getting here. So we get a pretty nice equity curve. Things look very fine. And now if we go ahead and say, okay, I'm going to trade this with 1/3 of the risk so that I get a better risk reward. What happens? As you can see, it's still going up, but actually our drawdown increases here a lot. I did run this before, so here's the results so we can have a look and compare them. The winning percentage doesn't change too much. Here we have about 47%, here 50%. But what changes drastically is the total profit, which goes down from about 50,000 to 30,000. While at the same time, and that's the important part here, our maximum drawdown goes from just $6,000 to almost $10,500. Also, the maximum drawdown length goes from about 50 days to 307 days. So in other words, what we did here was we decreased the stop loss. We decided to go with a smaller stop loss with the idea to have less risk. And it's true, on a single trade basis, we would actually have less risk, right? Now looking at a series of trades though, things as you can see look very different. And what happens in this case is that actually, without a doubt, we increase risk. We can also see that looking at the MAR ratio here, which compares the yearly profit to the maximum drawdown. And this value goes down by almost 3 times of what we had before. And we're also going to see this looking if we compare the equity curves. This is on a trade by trade basis now. During that time here, the green line, which is the original version that's used with 1.5, the average true range, does significantly better than the other one. And it's periods like that you have to keep an eye on. When everything's going fine, like during these times, the difference isn't that big, right? They're pretty much the same, and you can see that if we look at the equity curve before that, then they are pretty much the same. But when things go not so good during a drawdown time, this can make a huge difference actually. And you wouldn't know if you wouldn't backtest, right? If you would just look at the first couple of trades here, you would come to the conclusion, oh well, let's use a stop loss of just 0.5 instead of 1.5 because it's pretty much the same. And using that smaller stop loss, I can maybe risk more contracts and so on. In this case, the idea having a smaller stop means less risk isn't true. Alright, so thanks for watching. If you're serious about trading, you might want to consider joining our trading community at tradingeducators.com, where you can sign up for free and become a member. You're gonna get access to trading forum, our ebooks, articles. You can watch more videos there, and you can get the weekly ChartScan newsletter where you can find all the new articles, videos we're doing, and other educational stuff. If you have any questions, also feel free to send me an email to marco@tradingeducators.com, or if you want, leave a comment on YouTube, which you can do somewhere down here. If you scroll down, you should see the comment section. And I'm always happy to get some feedback on these to see where you might need help or what to explain better and so on. All right, so see you next time. And till then, have some good trades.